Hello, I'm James Hart, Investment Director of Witan Investment Trust, and I'm joined by Andy Headley. Andy is Managing Partner and Head of Global Equities at Veritas Asset Management, one of the managers in our core global equity portfolio. Veritas look to deliver consistent long-term real returns by investing in a concentrated portfolio of high-quality, large and mid-sized companies from around the world. We're going to talk today about the qualities that Andy looks for in the companies he invests in, and also the price which he's prepared to pay for those assets. Andy, welcome.
Good afternoon, James.
Should we start off by thinking about your investment philosophy and maybe talking about some of the characteristics that you look for in the sorts of companies into which you invest?
Definitely, yeah. So we have a super simple investment philosophy. Basically, what we're trying to do is we're trying to identify companies that we see as high quality and then simply buy them when we think they're attractively valued. And then having done that, our aim is just to hold on to them for the long term. So that way we benefit from the growth and the compounding of their profits and cash flows. Now, the characteristics we tend to look for in those companies are those characteristics that are shown by a high quality company. So things like high return on capital employed. They have to have strong barriers to entry, dominant market positions, very cash generative, strong balance sheets, the ability to grow, and obviously, as you touched on, an attractive valuation. Now, what we're really looking for, of course, are these companies that have all those things but can keep those things in the future. So they have to be durably competitively advantaged. So really, we're looking for companies that are high quality and will remain high quality for the long term.
So, with this focus on quality, Andy, I mean, it sounds like a sort of unique set of characteristics that these companies have. Does that mean that you have a relatively small number of companies that you can invest in, or is this sort of durability available across a wide section of the investment market? For example, are you able to invest in many different industries, or are you limited to just a few?
Well, that's a really good question. What we find are that high quality companies actually come about in a certain set of different industries and can be anywhere geographically. To be a high quality company for us, you basically have to be able to do something that your competitors can't. So that you've got something that allows you to operate and your competitors can't copy whatever that might be. Now there's only so many things that allow a company to do that. And they're typically barriers to entry that prevent your competition from being able to effectively compete with you. So you do something, I mean, if we boil it down, you do something better or you do something cheaper than your competitors can, or ideally you do both those things. And so when we look at it, there are probably 7 or 8 barriers to entry that we look for, which are kind of generic barriers to entry, but can apply across all sorts of different industries. So it's things that you will have heard of before, like network economies, scale economies. So if we were to look at companies that fit within these things, if you look at network economies, it's things like MasterCard, card network. It's very, very difficult for anyone to compete with MasterCard and Visa. The same would go for Facebook and Google in terms of network economies. In terms of scale economies, you've got the likes of Amazon, or in healthcare, something like United Healthcare or Thermo Fisher. Branding is another barrier to entry, and so we've got things like Disney and Nike. In terms of switching costs, which is another barrier. So this is a barrier where it costs the customer to move from one company to another. That's things like Fiserv, again, Thermo Fisher. And then another one that is popular with us is we look for companies that have their own intellectual property. So it might be a patent or other know-how. So, within the healthcare field where we have quite a large holding, it could be a company like Cochlear. So Cochlear make cochlear implants to help people who are profoundly deaf. They have a 70% market share. So obviously they have a huge amount of IP. But equally, in a different industry, take aerospace. We have a holding in a company called Safran, which makes aerospace engines. And again, they have a huge amount of intellectual property to allow them to do that so that their engines are more fuel efficient than the competitors. We get these strong barriers to entry across all sorts of different industries. And so that's the sort of thing that we're looking for when we're looking for high quality companies that have this protection. And obviously, the best thing is where you get multiple barriers to entry. So, taking a company that people will know well, something like Google. Google has network effects. It has scale economies. It's obviously got branding. I mean, Google is now a verb. It's got switching costs. It's difficult for people to move away from it. It's got intellectual property. I mean, it has all of these barriers to entry, which make it a very, very strong company that is almost impossible to compete against in that core search field.
That's fascinating, and presumably, when you're talking about companies that have such strong characteristics and are of such high quality, quite often they're very expensively priced in the market because a lot of investors will be chasing those sort of qualities that you're talking about. So how do you think about attaining these future growth rates, but not overpaying for them? And perhaps maybe you can give us an example of how you think about putting this into practice.
Yeah, it's a very important aspect of investing for us is the valuation discipline. It's actually not that difficult to find companies that have strong barriers to entry, but that doesn't necessarily make them a great investment. Just buying companies that have very strong barriers to entry, regardless of the valuation you pay, is not going to work out that well in the long term. We're very confident that it's important to understand the value that you should pay for these things, even if they have strong barriers to entry. And so the way that we operate is we look for companies that generate a huge amount of cash. So we try and analyze what we call free cash flow, which is the cash available to shareholders after they've spent everything in terms of maintaining the business. So all of that capital expenditure they might need to do has come off. And we look at the amount of cash they generate after that capital expenditure. And we then try and assess how that will change over the next 5 or 6 years. And then we value the company in 5 or 6 years' time. So we're looking to value a company today in sort of 2027. We're trying to put a multiple on their cash generation that we think they will deliver in 2027. And we're very prudent in our forecasts as to what we think they will deliver in that time frame. Once we have that value for the company in 6 years' time, we then work out the rate of return that we will achieve if we invest in the shares today. So let's say that we're looking at a company and we think it's worth, maybe we think it's worth around 15 times its free cash flow in 2026. And we think in 2026 its free cash flow will maybe be sort of $6.50, $7 a share. That means that the value of the company today is about $100. And then we look at the share price today. So let's say the share price today for that company is $50, and we think it's going to be worth $100 a share in 5 years' time. We work out the rate of return between today and that number in 5 years' time, and that would be a 15% rate of return for that company. And generally, for most companies, that's the sort of return that we're trying to achieve. We're obviously absolute return investors, and so we're trying to achieve this 15% rate of return in most of the companies we look at. Now, generally speaking, if we can do that, it means, or if we can find companies that will deliver that, it means that we automatically build into our process this margin of safety. We like to think that we will deliver for clients a kind of CPI plus 6 or more as a return over the long term. So if we think CPI is averaging 2 to 3%, I know it's higher today, we need to do kind of 9, 10% nominal return to achieve our targets. And we're aiming to invest in these companies at a 15% return. So we've already built in this margin of safety in that if we make a mistake in our forecasts, if we misanalyze the strength of a competitive advantage, if we're holding quite a bit of cash in the portfolio, that allows us to dilute that 15% a little bit and still achieve a good return for our investors. And so we've tried to build into the process this high degree of margin of safety in all the investments that we make.
And of course, the numbers that you're referring to there can't be guaranteed, particularly not at times in the market where I think it was one of the Federal Reserve chairmen referred to as irrational exuberance. at times where the market is particularly frothy. Now, you've done quite a lot of work on this idea of mass psychology, haven't you? Can you explain a little bit about how mass psychology fits within financial markets and how thinking differently from the herd can help you become a better investor?
Yeah, so markets are extremely interesting from a psychological point of view, and I think to be a good investor, you need to be aware of the pitfalls, the psychological pitfalls that abound in markets, and it's really the psychology of crowds. There are some fantastic psychologists that have done a lot of work on this. So Amos Tversky, Danny Kahneman, Robert Cialdini. That there's some really good and interesting work out there, and there's a lot of pitfalls that you have to be careful of. Just to name a few things like anchoring, social proof, sunk cost fallacy, confirmation bias. These are all things that you need to be very cognizant of, and I would say that to be very successful over the long term, I think you need to be aware of not only these psychological pitfalls, but you have to be uh, understanding of the need to be to a degree contrarian, but contrarian in the right way, and the need for humility. This is a job that requires and serves up a large degree of humility from time to time. And so you have to be aware of all of these psychological pitfalls, I think, to ensure that you don't get dragged into the crowd, particularly at the wrong time. I think there's a famous saying about men go mad in herds, but only recover their senses slowly and one by one. And I think there's a large degree of truth in that. In fact, one of the early I guess, proponents of psychology is Gustave Le Bon, who wrote a number of wonderful books that I thoroughly recommend and really studied basically how crowds go mad all at once. And it really does apply in equity markets and probably in all markets.
Andy, thank you very much for spending time talking to us today. It's been absolutely fascinating.
It's a pleasure, James.